Good morning to all the participants. Madam, can I upload my presentation?
Yes, sir.
Yeah, you have to screen. Is it visible?
Yes, sir.
Before I start, I have a disclaimer on the presentation. I appeal all the participants to just read my disclaimer because this is very, very vital for the whole presentation, hence my appeal. Okay, having read this, now let us quickly go to the contents of the program. And here I have taken a case study and convert case study is bundled with other aspects, etc. And for the purpose of valuation under various regulations, what you can do. And I'll be touching upon the valuers who are in the category of plant and machinery as well as land and building, so that it becomes easy for them to understand. And to start with, I'll be just giving the contents of the thing, that what the report should contain. Because once we know the contents of it, it becomes easy for a valuer to build up his report. In that context, I would say that the report should contain executive summary and followed by the introduction to the assignment. Introduction means introduction to the assignment. Then we should be very clear on the scope of assignment, title and ownership, and brief particulars of the company, and thereafter the date of engagement, date of valuation, date of asset verification, date of last information received, and date of report. Why I say this date of last information received? Because here I see a lot of people or the participants here are practicing valuers, and everyone will write the date of engagement, date of valuation, date of asset verification. Many are missing date of last information received. What is the information this gives the user of the report at a later date? There is an inordinate delay in compilation of the report by the registered valuer. And there is a need for the valuer to protect himself. Then nothing stops him inserting a column in his report, the date of last information received. And the true aspects will be, this will establish him there is no delay from me. The probable issues that can crop up on a valuer at a later date as regard to the delay from the valuer's point of view can be avoided. This is what is the suggestion from my side. And we should address about the location. And the location is not necessary to the land and building valuer. It also applies to the plant and machinery valuer also. I will address this when I come to the next aspects of the more details about this. A brief on industrial production capacity. This applies to both the values. Description of land location and manufacturing process, and brief and other systems, sanctions and approvals, financial position for the past years. Unfortunately, the tangible asset values, being engineers, are not abreast with the financial aspects because it has not been taught in their engineering. And I would submit all of you to acquire the basic knowledge of finance. You need not have to be an expert. You need not have to know the valuer, need not know how to write some books of accounts. At least it is duty of a valuer to understand it, know it, how to read a balance sheet. Without which, without reading a balance sheet, no valuations under RV, I don't think it can be done. Though it is a pure valuation assignment, is a purely technical assignment, and finance goes hand in hand. Whether it is a land and building value or a plant and machinery value, there is no choice for him but to go with the balance sheet, because that balance sheet gives a lot of signals to the valuer, and that can make his valuation assignment very easy. In that connection, you should be aware of it, and nothing wrong in recording his observations in the report. Observations in the report. Then what I said, the basis of value. The basis of value is one of the key factor, and which we will see how the basis of value are going to be derived in the valuation process when we explain the thing. And valuation methodology, what we adopt and why adopt that methodology are the things to be seen. And then valuation conclusions, and after the conclusions, you have to, it is bound duty of a valuer to clearly explain assumptions, limitations, disclosure, and departure. Departure is a very crucial aspect for a valuer. We should not forget it, because it is a duty of a valuer to submit all the reports or prepare all the reports in compliance with the IVS standards as per the current regulations, and the rules are in force, and that need to be emphasized. And departure is the one thing we are ignoring it. Departure, there is always, in the initial time for a valuer, we always get confused because there is a thin difference between the departure and disclosure. Departure is totally different, and disclosure is totally different. Once you understand the thin difference between these two, probably the valuer's handling of the assignment becomes much easier. Hence, I am touching on a departure also. When you start writing the departure, that gives an indication your strength in the IVS. Unless a valuer has thorough in the theoretical aspects of the IVS. First is theoretical aspects of the IVS, which is very, very crucial. That is reading of the IVS, understanding of the IVS. Mere reading of the IVS will not take valuer to anywhere. It's understanding to what extent he has understood it. That gives a next step to the direction. Having understood that, the crucial aspects of the IVS is the application of the IVS to the specific case or the specific assignment, what the valuer is doing. That is very, very crucial. Unless he is not thorough with the application of IVS, one cannot say that my report is in compliance with IVS. That is the reason, not only reading, understanding it, and interpretation of it, and the application of IVS to the specific case. Interpretation and application could marginally vary on case-to-case basis. This is where the skill of a valuer and his strength lies, and that is where the glory point, that is what is the glory point for a valuer to succeed in this profession. And disclosures and material involvement, and the extent of investigation. The extent of investigation, more particularly in every valuation, more particularly the corporate valuations, whether it is the private valuations or IBBA valuations under Companies Act or under IBC, whatever could be the thing, is a very, very crucial. And extent of investigation should be convincing, and explanation is a must to that effect. Otherwise, the report can be termed as incomplete, or it can be biased. Unless a valuer substantiates the investigation and compliance in his report, the report can be termed as a biased, maybe by the authority or the person or the courts who are going to challenge the valuation, or situations where the valuation report is put to cross-examination. That is where what are the components that come in the investigation part, which the valuer need to decide based on his experience and try to incorporate it. And nature and source of information relied upon is a very, very crucial aspects to disclose it, because every report need to be transparent. From the angle of transparency, this becomes very vital. And of course, having done all these exercises, obviously the report becomes his proprietary document, because he is going to be the author of it. Naturally, he has to give the restrictions on publication and use of the report, without his permission, because any wrong deeds done by the user of the report, there is a possibility that the valuer can turn to be answerable for the misdeeds of someone. To protect himself from such dangers and such probabilities, it is always ideal to put restrictions on the publications, and valuation standard do give authorization or the license to the registered valuers or the author of the reports to have this right within himself, and limits or exclusion of liability to parties other than the clients. This compulsorily need to be recorded in the report, because when we look at the basis of valuation, if you understood the basis of valuation, is very clear for what purpose it is done, what is the application, who is the intended beneficiary of the report. These things are being explicitly mentioned directly or indirectly on the basis of valuation. And having mentioned that, this gives a clarity that if somebody, there is always a possibility of misutilization of the report. To avoid that scenario, it is very, very essential. And valuer need to confirm that his report is in confirmation of the valuation standards, whatever he uses, whether RICS, ASA, or European standards, Malaysian standards, whatever the standards he is using, he has to disclose it. And what currency he has used, it has to be done. Then he has to disclose his qualifications, and more particularly his competency to do the exercise, and validity of his license need to be exhibited under qualification of values. This is what is the basic summary of the report. And of course, these are to be supported by the respective calculations, what all the relevant calculations, etc. And when I say the calculations, etc., there could be a little issues like formulas and other things. Those need not be disclosed. You can always claim it is your proprietary issues. Probably more particularly the formula when you adopt, when you do a DCF valuation, discounted cash flow valuation, and all those things. However, the rates at which those things are being calculated has to be disclosed. Formula can be your proprietary item, but the rates and the treatment, whatever you give, there should be a transparency. Every treatment, etc., should be there should be a transparency, whether the land and building valuation or a plant and machinery valuation. And to make the report complete, to have a pictorial view of the asset that was valued from the user's perspective, you can attach few sample photographs of the assets that are covered in the valuation report, so that the report can be termed as a full-fledged report. This is the basic things which I am telling. Why I am started this way is only for the people to understand from the practical perspective. Practically, each one of us doing. While doing so, I am trying to make a built-in scenario for the IVS application in a report. Any questions at this stage? You can interrupt me. I will not be disturbed.
Carry on, sir.
Okay, thank you. Anytime if you are finding out of the way, if you finding it difficult, please interrupt me. I will explain those scenarios either in the in-between or at the end. Don't think that I will be disturbed. My track will not be disturbed. And in the valuation report, the first will be giving the introduction, the major points. This is not complete, I say. These are the minimum points that need to be covered, or who is the appointing authority for the exercise. That should be very, very clear. Under which contest he is appointing, that is also important. Purpose and the basis of this valuation exercise, that is the contest under which he is appointing you as a valuer. That has to be clearly exhibited in the report. Maybe not necessarily in the bullet item. For the purpose of understanding, I have made a bullets here. You can explain by a paragraph all the details, etc. Sorry. And what are the assets that are covered in this report? Whether this report pertains to land and building or plant and machinery, or also the report covers inventory if it is within the scope of your exercise, Of course, I am not touching the SFA for various reasons in this presentation. All the assets, what all the assets that are covered in this report has to be clearly mentioned, and location of the assets, where all you occurred, what are the locations the assets are. If the unit has got the manufacturing facility or the company has got multiple locations, what are the locations the assets are located? Those also need to be explained here, and date on which the value to be estimated, that is the date of valuation. What is that? And dates over which the assets were verified by the valuer. These are the things which gives a predominant overview of the contents or the how the report is going on to the reader of the report. That is how this becomes very, very relevant in the stage of an introduction. And having introduced it, we need to clearly explain the scope of this assignment, that the scope of each assignment, what a valuer is doing, it should be very clear what is the scope he is being entrusted with, and need to mention explicitly, including specifically, the interest of owner over the assets to be valued. Why I say the interest? Generally, we say that it is the asset value, but asset, the moment we call it as an asset value, the meaning it gives is a real estate valuation, not real property valuation. As professional valuers, more probably registered valuers, we are supposed to do real property valuation, not real estate valuation, as per the regulations. I'm using the word as per the regulations, what we are supposed to do. Having said this, we need to identify the interest of the owners over the asset which we are going to value, whether it is a freehold interest or a leasehold interest, whether it is a long-term lease, short-term lease, what are the applications, etc. We need to identify those things, and those identified title has to be valued by a valuer. This is what need to be, I call it as the scope of this assignment. Again, coming to that, in order to, having set the scope of the assignment, we need to clearly exhibit in our report that to ascertain the title of the ownership, over the assets under discussion, what are the documents we have verified? We need to explain there in our reports. It is easy for a land and building valuer that he will peruse the sale deeds or the khata extract or other allotment letter, government relative documents, etc., and explain it. Whereas for a plant and machinery valuer, on what basis you confirm the authenticity of the ownership always becomes a challenge. The documents for that should be the first and foremost is the balance sheet of the organization who are owning the assets. That is very, very crucial for a plant and machinery valuer. And if you say that plant and machinery valuer, under the asset category, schedule of assets, it will be there, land, building, and plant and machinery, other assets will be there. And that gives an indication of plant and machinery, yes, they are owned by the company. Also, that will help you, if at all you know how to read a balance sheet, you can always identify any leasehold assets are there or not. And when it comes to plant and machinery, that gives a summary in the balance sheet. And schedule of the balance sheet, schedule of the fixed asset gives a summary. And summary will not exhibit if there are 4,000 items or 300 line items in the plant and machinery. To establish the ownership, the biggest document which comes support to the valuer is a fixed register, which need to ask for the copy of the updated extract of the fixed register, and that need to be examined and used for physical verification of the asset. Without that, it could be difficult. the valuer could pose a challenge that company may not be maintaining the fixed register. In such case, the list of the fixed plant and machinery and other allied assets which falls within the scope of work should be collected from the appointing authority, and a disclosure to that effect need to be made without forgetting that valuer has not been provided the fixed register. Only when a fixed register is made, updated fixed register is made available to a valuer, he can 100% vouch for the ownership of the assets, because nowhere the name is written, none of the assets. The only document becomes him, because he may not be able to get invoices, bills, etc. for a 15-year-old, 20-year machine, etc. And the testing point is gross block of the fixed assets, specific category from the fixed register, and the net block, whether they are in agreement with the financial statement or the balance sheet given by the valuer, and also whether it is a land and building valuer or a plant and machinery valuer, need to identify whether any intangibles attached to the thing. The moment the intangible word comes, it is the concept of a valuer, more particularly tangible asset valuer, to express that it is not our cup of tea. It is falls under the scope of a SFA valuer. My submission to the participants is, yes, at first instance, intangible assets fall in the domain of a SFA valuer, provided they are independent intangibles. And the entity may not have independent intangibles. They have a intangible, they could be having an intangibles which are an integral part of a land and building or a plant and machinery. If such scenarios exist, then that becomes the primary duty of a tangible asset value to identify intangibles attached to the tangible asset and carve out separately in his report. That is where the challenge for a tangible asset value lies, and it is he is duty bound to do that. Otherwise, defeating the purpose of valuation, and whether in the general courses, the valuation can turn to be undervalued in the absence of intangibles bundled with a tangible asset, or in the case of an IBC situations, the very spirit goes with the maximization of a value, and that very spirit gets defeated. However, the safety factor here for a valuer is he need not have to. Prima facie, he is looking at the bundle of rights and he is classifying it, and he is doing the exercise as your title is concerned. And definitely he is not a legal expert. Being not an illegal expert, he will not be testing for the 100% ownership and other things, litigation issues, court cases, etc., all those things, which he can clearly exhibit in his report. Having done this, next, he will move to the particulars of the company. When you say the particulars of the company or the organization which owns the asset, or that what he is valuing, he need to identify when the organization was established, when the commencement of production was made. That means the history. He should go look into the history of the organization, because there is a lot of significance in the valuation process, and whether it belongs to industrial groups, if any, and location of registered office, corporate office, manufacturing locations, what are the locations, why this is required. There may not be any asset. The RP will say, or the author will say, you visit the plant and value the assets, plant and building or the plant and machinery. More particularly, if it comes in the IBC, it says that all assets of that category, the moment the RV is appointed, he is duty bound to value all assets of category. If he is a plant and machinery valuer, furniture fixture falls within his domain. And manufacturing facility, he visits and does all the things. There are some assets in the corporate office in a different location, he has not gone there. And that can amount to undervaluation at a later date. Registered office, there could be some assets. To test where are the locations of the asset, when a company valuation is done from an overall perspective, if you are able to have a practice of identifying these locations, in the very report itself that gives a signal for us what all the things we are expected to cover. And that also will help the reader to understand what all the assets that are likely to be covered in the report and what are the products the company is currently manufacturing. This gives a clear indication what segment the company is there and what is the potential for the products. And this relates more to a plant and machinery value. If the potential is, the product is not there, probably it gives a caution for a plant and machinery value that the machineries do not have value. Whatever could be the economic value, whatever could be the engineering life of the machines or the assets, other assets. Similarly, in the land and building value, I don't know to what extent many will agree with me that if the products have no demand, the asset, the land and the building, what he values for the continued use of the asset from the same location, the existing use, that is what normally he does the exercise, to what extent that value could be sustainable. Probably he may have to think from the angle of continuous of the asset from the same location or alternate use. Probably that land and building values have to think deeply on these aspects and details of collaborations, if any, that gives a good signal on sustainability of the products and its utilities, etc. And any past major shift in the management, like change of the group or acquisitions, etc. Why this is required? Today, a valuer can think that today he is valuing the asset. He will see the asset and value it. But if he is relying on the financial statement to a certain extent while doing the exercise, in case there is a change in the management, etc., there is a very possibility that the assets are revalued at the time of changeover. And also, if any public issue has been done in the past, etc., or diluting of the interest of the promoters, etc., there is a very possibility. That means he can be cautious on the gross block of the asset in the fixed register of the financial statement so that he will not be misguided by the figures, original figures. And any other historical fact that are essential to be recorded. Whatever the valuer in his wisdom thinks that these are the essential things need to be recorded in the report. Either it is a caution for the valuer, these recordings, for the future process of valuation, or it could be caution for a reader or the end user of the report, how he need to look to the contents of the valuation report. In that context, these brief particulars of the company are being given. And location, discuss on location of the asset, zoning, etc., connectivity by road, rail, air, sea, proximity to the nearest village, etc. There are reasons for this, why you need to discuss this, what are the zoning, etc., whether it is an isolated industry or it is in the cluster of industries. Like you should cover about infrastructure, density of industry, distance from habitation, surrounding population, availability of services, availability of skilled labor, managerial force availability, etc., and the locational advantages. These are the why, these are the things, the contents under this heading are the driving factors to determine the value of the asset, be it a land or a building valuation or a plant and machinery valuation. If the asset is located in an isolated place and the skilled labor force is not available, it's a negative mark for the asset because the cost of production will increase. If the cost of production is going to increase by bringing the labor from outside, there's not an impact on the value of the asset. If you go deep into the value assessment of various aspects of costing to the value, then these things will play a very vital role. Then brief on industrial products and capacity. This got a bearing. Discuss on products manufactured by the company or suitability of the plant to manufacture various products and byproducts, whether the products and capital goods, consumable, whether it is a consumable or consumable capital group or OEM or a replacement market, consumable, etc. These are the driving factors for the goods of the company. If the driving is very good, probably the economic value of the assets will be much higher. Discuss on the unit's installed capacity and immediate past year's capacity utilization. This speaks about the past management and sustainability of the infrastructure to give the expected output. Whether it's an export-oriented unit, that is where I say proximity to air and sea. That is what we see where the company is manufacturing export-oriented units. And if they are export-oriented, then the market for the product has to be addressed here, indirectly or indirectly. Whether potential products or items made in collaboration, whether collaboration is there. Discuss market-wise demand-supply gap about the products of the unit. Discuss product demand, if any. And latest information, whatever the information available. For a sample, I am showing the components which are manufactured by, it is a template of what template I used. I am just exhibiting here. A two-wheeler component, three-wheeler, this relates to an automobile industry. You can just see what the installed capacity of the thing. See, look here, the installed capacity is so high, the production in the past is so low, and the production in metric ton is also low. This gives a low capacity utilization, and this gives a signal for the, while calculating, this gives an indication for you to test for the obsolescence factors, if any, why the products are not absorbed in the market, whether it is an account of the failure of the management or an account of the technical obsolescence, or could be an account of the economic obsolescence. Reason being, the cost under which you supply to the market could be higher than the competitive product available in the market, which has got a direct impact on the value of the asset. These are the things which falls into the domain of a plant and machinery valuer, which he needs to examine clearly, and probably very little in the case of a, not that I cannot say it does not fall, it yes, definitely does it fall, but to a smaller extent in the situation of a land and building valuer. And description of the land location, discuss micro details of the asset location. Micro details of the asset location has to be discussed. And here, if you look at this specific case, deliberately I kept it as it is. And if it says that it is spread in about 18.5 acres approximately, and adjacent to it, another 8 acres land is there. And it is the corner property and owned by the company, and also has got an infrastructure. If you look at the pictorial view, I'll explain it here. If I say this what is the 23 acres, no, 23 acres. I don't know whether you can see the cursor in which I am moving. This is the property, including the vacant land portion. The bottom portion of the two pieces of the lands, what you see here, this comprises of 18 acres. And this is the other one, which is about 18 acres. Land exists on entire land of 23 plus 8, 31 acres of land approximately. The manufacturing facility is located. However, this we have classified as a vacant land for the reason that here temporary structures are here, but for this is a vacant portion which is owned by the company, whereas the top left portion of the land, about 8 acres, is not owned by the company. However, this portion, the land portion, having not owned by the company, has got a lot of manufacturing facilities or the support facilities which are vital to run the units. Now, You may ask a question, why a land and build plant and machinery valuer has to ask for a land details and the land particulars, etc. This is a classic case. How a plant and machinery valuer is going to value the assets here over this portion of land which is not owned by the corporate debtor, whether it is for the purpose of secure lending or for mergers or for any application for that matter, maybe under IBC, whatever could be the application, what treatment he is going to use it. Whether it is available to the owner, this is a real challenge. Just because he cannot say that, I saw the machinery valued. No, what basis he is valuing? He's got only 4 options, plant and machinery valuer, and whereas land and building valuer has got 2 options. Plant and machinery valuer has 4 options, that is continued use of the asset from the same location at the existing use, option 1. Continued use of the asset from the same location under alternate use. Continued use of the asset from alternate location at the existing use. Continued use of the asset from alternate location under alternate use. There are the 4 options available for a valuer depending on the basis of value. While he determines the value, he can estimate and conclude the value. Whereas land and building valuer has got only 2 options, continued use of the asset from same location, existing use or under alternate use. Keeping this spirit in mind, the treatment for this portion of the machines have to be addressed and which are very, very crucial. And we will address this probably, I don't know, if this portion, the treatment of this itself will take almost an hour or so. I don't know, it should cover depth into it. If needed, I will try whether at the end I can explain to it. And these are the plant locations, etc. And again, I'll address this later. Why I was talking about, okay, I'll take here only. I was talking about the departure, how the departure has to come. If a single entity or a team of valuers who are known to each other jointly doing the valuation exercise of this similar type of industry, especially the buildings, etc., these are the things. The classification of this building, whether land or building or a plant, becomes a first matter of discussion or a first matter of classification. In isolation, there is a possibility that land and building valuer will think the plant as the buildings are a plant portion, he will not value it. And other person also will not value this, thinking that land and building valuer has done it. And there is a very possibility that the value of this portion of the building can be dropped out of the assignment, or alternatively, it is vice versa. In the other thought process by the individual valuers, this can appear in both the reports, resulting in higher valuation. To avoid that, it is the duty of the valuer of each category to seek a clarification from the appointing authority who is covering these aspects subsequent to the inspection date. Because till inspection, nobody will be knowing whether it is classified, can be classified as a building or can be classified as a plant. They need to explicitly obtain clarification. If suitable clarification is not coming through to his satisfaction, then he need to give a departure to that effect using his wisdom to consider it, not to consider. Either way, he is giving a departure to that effect so that his report is in compliance with IVS. And again, why this has been marked separately, the vacant land portion have been shown separately. Here itself, I'll give an indication to the valuer, especially when you are doing a IBC valuation where value maximization is a spirit under which you are working. In the case of a resolution process, we address about 18 acres of land, combination of this vacant land as well as this building. Anyway, we are not discussing about this third-party land. And probably you may give a uniform rate because it is for the continued use and only the ownership is going to change and the activity of the business is expected to be continued with a different management. and you may afford, you may have a discretion to give a uniform rate based on the wisdom what you decide. Whereas when you are doing for a liquidation process, and as you see, as you must have seen, the liquidation process gives different options, etc. And probably for the vacant land, you may have to give a higher value because it has got a potential, has not sealed. It has got a bigger potential than the portion of the land which is already married with the structures. That is where the carving out of these things becomes. Also, the regulation says that the value of the assets in parcels. And the question always comes, machinery valuers will say, oh, 10 machines, one parcel, 3 machines, one parcel, like that. Whereas land and building valuers always under the imagination that it cannot be parcel as single always. No, it is not true. Here also parcels can be made and value maximization treatment can be given. And also this gives an option to a RP to sell the assets independently. One portion can be sold independently, other portion can be sold independently because they have got a wisdom to do that and have powers also, they are permitted also to do so from the interest of value maximization for the stakeholders. And the manufacture, next comes the manufacturing process, and to be highlighted in the para, in a para or two, this you should highlight it, what for the product, the facility being utilized, and product-wise manufacturing process essentially to be in brief. Probably this is more relevant in the case of a plant and machinery valuer, and such an elaboration definitely not required by a land and building valuer. There is no need to get confused, and the plant and machinery valuer has to discuss on the byproducts, if any, and whether byproduct is with value addition or without value addition. Whether with the value addition, you call it a secondary product, or how the classifications are done, and probably that will, in a larger analysis, if he is doing to do in the exercise at the time of conclusion, probably that will help him finalizing the contribution from each product to the benefit of the company, what contribution the company is going to get. And there is why I say this, there is a very possibility sometimes there are situations where the byproduct itself taken the major product and the real product has become a secondary product. There are situations in a manufacturing plant probably that will make a thinking process of a value in a different way to make the precise valuation. Manufacturing process specific to the unit, preferably to each major project wise, if there are multiple products, can be explained. This gives enough clarity to the reader about the stages of manufacture, major raw materials used, manufacturing process, including intricacies, technology used, and extent of manpower requirement, including their levels of skilled, unskilled, etc. And if possible, address about vintage of machineries for the current activity. Unless you address the vintage, probably the substantiation of the value arrived could be incomplete if a vintage has not been addressed in the report. And of course, both the valuers will be addressing the sanctions and approvals of the project. What all the sanctions are there? What are the approvals? When I call it as the sanctions and approvals, in every activity, manufacturing activity or the trading activity, whatsoever it is there, well, two set of the assets are there. Sanctions and approval are there. One set of approvals are related to administrative, though statutory in nature, from commercial perspective. In the sense, the ESI, PF, the sale tax, commercial tax, excise duty, and all those things, etc. It is not that essential for an asset valuer to discuss too much on this. Don't get confused statutory approvals. What statutory approval that are essential to make the owner of the asset to use the asset uninterruptedly are the ones which are very, very crucial, which need to be addressed, and absence of which there is a very possibility that the asset may not be permitted to use by statutory authorities. That is where the, more particularly that relates to manufacturing activity related, the licenses, etc., regulatory and statutory. They are the two things. There are again regulatory and statutory are the ones which need to be addressed in the report, and that will give enormous input to the value conclusion. I would say that. I was talking about financial statement, how a financial statement can give a value addition to the valuation report for value conclusion. I mean to say, if you study the last, here in this case, we have studied about 11 years, last 11 years, if the data was available, it is not essential for everyone to study for 11 years. Definitely, I don't recommend everyone to make a research on this, definitely not. However, if you are able to do for last 3 years, that should be fair enough. Whatever the last 3 years, if you are able to draw the financial statement and see here, this particular company, net worth is positive. Generally, when you see any company under liquidation, net worth are invariably not positive, they are negative. Once you get into more and more details, you will be able to understand this more depth only of the thing. Probably many of you, some of you could be doing, many of you could not be doing it. And when you see net worth, then when the net worth is positive, still the company has gone for a liquidation in spite of so much of capital and the other resources available with the company. That gives the indication that gives a signal for a registered valuer to know that to do the exercise cautiously, because there is a lot of bungling could be there in the accounts, books of accounts, etc., all those things. Many of the assets could be fictitious assets or non-productive assets, or fictitious assets could be there in the whole statements or the data, whatever you give, whether physically or through data. These are the signals what you get it. And look at the rate at which it is falling, and you can understand it. What could be the reason? Is it for a technical reason or a management reason? When the company was making a profit 3 years back, suddenly 2 years was such a loss, etc. What could be the reason? If you make an analysis with regard to the industry average for the specific industry, then you will come to know about it. Whether the failure is on account of the management, or failure on the machinery, technology, or the cost of production, etc. That gives a true signal for you to give your discounting or the depreciation for the purpose of technical obsolescence or economical obsolescence. And of course, management failure you cannot give under the asset valuation, but that is outside the asset valuation. That is an input for the valuer for the process of value calculation. They are the signals which we have to use it. And substantiation. Suppose if you say that obsolescence is some percentages in your calculation, you say anybody can question you, why 3%, why not 6%, why not X%? When you go back and reiterate with these financial ratios, etc., probably you'll be able to correlate and identify these things, and that can give a bigger signal. And remarks on the financial position, probably once you are able to understand these things, you will be able to draw a thing. What are the intangibles? Any contribution from intangibles, etc. Also, you will be able to make out, and any royalty payment also you will be able to make out through the financial statements. And if a substantial royalty payment is there, you can see whether it is in relation to the production, what is the cause of the loss, is it on account of the royalty payment, etc. If the loss is on account of the royalty payment, etc., there is nothing wrong with the assets there. There is no technical obsolescence, whatever is the thing. that gives a good signal to give a depreciation for that. See, some of us are doing only arithmetical depreciation, that is for the age, and some are doing depreciation on account of various other things like various other aspects like technical obsolescence, economic obsolescence, all sort of a thing, etc. To finalize the percentages for this gives an enough signal. And I said basis of value. I was talking about a basis value. Base of value adopted is for determination of value through this exercise, whether it is a secure lending value, value under accounting standards, specifically mentioning under which sections the value has been assessed. Because the first time accounting, if you say maybe in the 14, there could be different, and 16 is value as per the specific for the accounting as on the record date. Maybe Ind AS 10 could be different. Ind AS 36 could be different. We should be very, very clear. Same asset under different sections could be different. And also, when you do a valuation in the AS, and depending on the treatment, type of asset, treatment also becomes compulsorily has to be changed. What IVS says? IVS says three approaches to valuation. First is the market approach. Invariably, for industrial units, very rarely we are able to do it. The market approach, more particularly the plant and machinery, and specialized buildings. In the case of land and building, they are unable to do it under market approach because of various reasons which you already know. Then next preferred option is income approach and cost approach as a last resort. Cost approach as a last resort. When I say the accounting purpose, if an asset need to be valued, is it what type of asset is classification of asset? Is it an asset under used by the entity itself, or is it an asset created for the purpose of generating separate income, not linking to the production? Is the generation of income is one aspect of it, whether it is a part of the manufacturing activity or outside the part of the manufacturing activity. That means a building is there which is generating rental income, excess of office premises which is generating an income. Under Ind AS, if you are doing, valuer has to compulsorily do it under income approach to valuation. Or some of the machineries which are given on lease to somebody else. The manufacturing plant has got certain machineries. Certain machineries have been lent to subcontractors. They are in their premises, owned by the company. Yes, you are valuing for the specific purpose. If those assets, if you are valuing under accounting purpose, those machines have to be valued the income approach to valuation, not under any other approach, because Ind AS of that specific reason clearly says they are investment properties, not directly contributing to the manufacturing activity. The contribution, these are the things which a valuer should do. That is why the basis of value for the specific application becomes very, very crucial for a valuer. And valuation for purchase price allocation, many a time when the transactions happens, happens on a slump sale, with the duty of the valuer to segregate, allocate the prices of each class of asset for the purpose of accounting, and in order to draw the new fixed register for the continuing entity. That is where the purchase price allocations are very, very critical. If at all any value comes over and above the if there is a slump sale value is higher than the total allocated value, then the difference in value can be classified as a goodwill, which the company will take care of. We need not to bother. That is where, and if the allocated value goes more than the slump sale value, then a deeper examination definitely required, because that is a signal for a valuer under purchase price allocation, what treatment company can give for it, what is the implication of the valuation, that you need to address those things. Valuations for mergers, amalgamations, demergers, etc. Valuations for stamp duty purpose, and valuation, when you are doing a valuation for stamp duty purpose, there is a possibility of suppressed assets. More particularly under the transfer price mechanism, details of these assets will be available in the financial statement. If you are not examining it, there is a possibility that you are going to undervalue the asset by ignoring the assets under transfer price mechanism. And remember, transfer price mechanism is different and purchase price allocation is different. They are totally different situations altogether. And value of assets under IBC resolution, value of assets under liquidation for services, these are the basis of value. On this basis of value should draw an inference that who is going to be what is the ultimate application of the valuation report. And once this is being determined very precisely and clearly, your valuations cannot go wrong under any circumstances. And it's difficult for the user of the report to counter you under any contest. That is what I would like to submit to the participant. This is what I say, to think on intended beneficiary of our report, including application of a report. If this last sentence is being kept in mind, probably the whole process of valuation could be very, very ideal. And you cannot afford to do any mistake. Now, I think we have completed the more or less 1 hour. Let me have some questions so that instead of going further, now I'm proceeding to valuation methodology. If any question of the participants are there, I'll be happy to answer before I proceed. I think the organizer will be okay with me. I don't know. You have to tell me. Organizer is there? Somebody can mute and answer. I don't know whether organizer is there or not. If anyone has got a question, they can unmute and ask me. Otherwise, it goes in the air. You are able to follow or not, I am unable because it's a webinar, not a classroom session, virtual physical session.
No, as far as I am concerned, I am okay with it.
Yeah, please.
Yeah.
You're okay.
Yes, sir.
Okay. Any other views? Shall I proceed further?
Sure, sir.
Okay, thank you. Then the question comes, based on the scope of assignment and the basis of value, we need to proceed for the valuation methodology. What methodology we are following? So this is a situation where in this situation, we are estimating the value for the liquidation process. When I say the liquidation process, there are 6 scenarios. 6 scenarios, the value to be determined. So you determine. And what is the practice that is being followed today for the value? Now, if I take an example of a typical secured lending valuation, the bank valuation, every valuer makes the market assessment of the market value, where the land and building value or a plant and machinery value, they estimate the market value. And once the market value is fixed, some bankers will ask for a realizable value. Some banks will ask for sale value. Of course, stamp duty value is something different. Let us not talk on the stamp duty value for the purpose of it. And similarly, the same case, in the case of a plant and machinery value, realizable value and sale value, they will ask for it. The question of stamp duty value is generally not coming in the case of a plant and machinery value. Now, what is the basis as a thumb rule people are adopting across the country? Market value minus 10% or is a realizable value, or minus 20% is a post sale value. And at the end, under the conclusion, every valuer is signing, this report is made in tune with IVS as per IBA handbook. Is it not? Or even under liquidation, fair value and the liquidation value under the resolution process, people do mention 80% and 100%. Liquidation under fair value. See what is happening. Then at the end, we confirm that valuation is compliance with IVS. That means we are giving long rope to the authority to question us and catch us at the rate of come. Whether you are 90% or 80%, whatever the valuer is doing, whether secure lending valuation or the other valuations under any of the regulations, is it a part of an IVS? Any answer to this? According to me, no. They are not forming a part of IVS. And by convention, it is happening. Can a convention be a rule? More particularly, when the valuation report is going to be tested in the court of law for various errors or omissions, commissions, because somebody wants to take advantage of our mistake and for that purpose. Technically, to be safer side, those need to be derived, determined through calculation, and there are methods to do that. I would like to submit. And that is possible only when a valuer looks deeper into basis of valuation. Basis of valuation, keeping in mind intended benefit of the report and application of our report. If these factors are addressed threadbare, probably one can derive through calculations those things, and it becomes difficult for people to question the decision taken by the valuer. This is what I would like to submit. Probably we will test those things when we come to a calculation part of it, if time permits. And here it is.
I
Please,
think
please.
calculation is, I think, very important, because whatever you are saying, 10% and 20%, this is what is going on. So I think
Yeah.
that question is very important. If you can cover that, I'll be grateful.
No, probably when I address the calculations, probably I'll be addressing the calculations are relating to plant and machinery in this case. Probably the same principle and the spirit will apply for land and building also.
Right.
Because I have not cropped up everything here, because I could not merge both the reports together.
Right.
Because of paucity of time, because I was traveling till yesterday. Last 1 week I was traveling. I could not do it. I'll try to cover that.
Right.
How the calculations are, how the fair value determination. See, now when I say here, I'll address this because it's got a final breakups, etc. An asset on standalone basis, an asset in the stock, a set of assets collectively, the assets in parcel, the corporate debtor as a going concern, or a business of the corporate debtor as a going concern. However, rest assured, the last one do not fall in the domain of a tangible asset value. And however, he cannot ignore this, because the regulation says that six values to be determined, and he has to mention this, and under the heading he said, do not fall under my domain. That is what is essential. Just because it does not come, he cannot ignore. No. Rule is rule. Rules are made to bind, and there are no eyes and ears rules. Everyone need to follow. Okay. And now coming to the application of the methodology, I say that there are three approaches to valuation: direct market comparison, income approach, and the cost approach. And the standard suggests that should be examined estimating the asset values in the same order of reference. And the standards say that market approach is the supreme. And if market approach for various reasons is not possible, next alternative available approach is the income approach. He has to address that. And if this is also not possible, the cost approach as a last resort. Why this is last resort? Income approach and the market approach gives the result of value from the demand side. And as professional valuers, we are the representatives of the market. We are supposed to make a statement on the demand, not on the supply. Supply side valuation are expected done by engineers, not valuers. Supply side is an estimation. That is supply side. And there should be always a last resort. And there are three approaches. Under each approach, there are different methods to valuation. It is the freedom of a valuer to do any approach in the order of reference. Sorry, any method, whatever he feels under a defined approach, he can use any method under the valuation process. When I say this, let me see that. Okay. I missed something. Okay. I wrote it. These three approaches are there before going to the next. What the IVS says. IVS clearly states that valuation need to be conducted minimum on two approaches to valuation. Unfortunately, many of us are not doing valuation assignments under minimum two approaches to the valuation to make a statement or a certification in the conclusion that our report is in compliance with IVS. There is mandatory to do IV valuations, calculations of valuation under two approaches to certify the valuation to confirmation with the IVS. But now, there is a safety factor for a valuer. It may not be possible, then he has to address the issues. Why market approach is not possible? Why cost approach is not possible? Why income approach is not possible? Whatever thing, that means it is ideal for him to address all the three approaches, what method he is finally choosing, and other method, why they are not possible in this case. That gives a safety factor for the valuer to opine that he has done his proper due diligence of what he is supposed to do it in the same order of reference. Then he becomes easy for him to get protected from any probable investigations at a later date. And for the people who follow, more particularly the plant and machinery valuers, could be following ASC standards, American American Society of Appraisal Standards. It becomes essential, mandatorily for valuer to address all the three. Though IVS gives a liberty of two approaches to valuation, whereas ASC stipulates that three minimum approaches to the valuation. Of course, anybody following RICS standards, they say about minimum of two approaches one can follow. And nothing stops a valuer in testing his approach with three approaches to valuation. With any of the methods suitable to him, he has to only apply different methods, say why he is choosing specific method, and he is free to follow that method. This specific case, to make you to understand the issues, etc. This case relates to a closed automobile component manufacturing unit, manufacturing automobile component, and this is a production line, manufacture automobile component suitable, and broadly follows the product type of layout. When it follows the product type of layout, then you have a constraints on the batching of the asset. You have got a limitation of making standalone valuation machine. This gives a signal for you. It is difficult for you to value as a standalone machines. And more particularly when it is a product type of layout. Product type of layout has to be in the batches, etc. This is a signal that gives you can take under the shelter and say, and These machines are not commonly bought and sold, and combination of selective individual machines in tune with the plant are available. And for this, hence, this is the market approach for valuation is not suitable. That means you first, at the first instant here, I have explained that for these reasons, market approach is not suitable. That means I tried to put my effort that market approach is not possible. And I'll be exonerated from the accountability of doing the exercise and the market approach. Now, coming to the income approach. Now, here the facility is closed for a long time and maintenance is not good, not generating in the unit, and the company is already under liquidation. And what is required to do the income approach? Past history is required, past financial data are required, cost of production, expenses, etc. The costings are required, which are not available. And also it is essential for the valuer to do projected cash flow to do a income approach valuation. And one catch here is one valuer should not forget, if at all a valuer is doing an income approach to valuation, the original income calculation has to come from the engager side or the owner side. Valuer is prohibited in generating his own income approach from his own side, generating the first set of income approach from his own side, because that gives a straightaway biased valuation opinion. Because IVS, International Society of Valuation Standards, which is a premier organization for business valuation, is an international organization headquarters in registered office in Canada and headquarters in USA, clearly stipulates projections need to be from the client side. Valuer is prohibited generating his own cash flow at the first instance. This we should not forget. And it is not mandatory for the valuer to accept the same cash flow what the owner of the asset gives to the valuer. He is permitted to change. He's got a full wisdom to revise it for the purpose of his valuation, then in order to get a full production and draw a value conclusion. And while he is differing with the cash flows given by the company, he has to mention why he is differing with it, and what he opines is then he has got a license and the freedom to capture it and do the calculations of the income approach to valuation. And in this case, because the unit is closed and already under liquidation, future income is not available, data is not available, etc. That is why we could not identify many mess, and also the stores and space are not there, the maintenance, etc. Income approach was not possible, and as a last resort, we have adopted cost approach to valuation. This is what I have said. With this background, see, further income from each of the machines are not available. None of the machines are capable of generating income. As such, income approach to is not available, is not possible. That means your report is transparent to that effect, how the process of value determination you have gone. That is the methodology what you have gone. You are making it transparent. And you are also, though, see now one point here, the plant and machinery values are addressing the plant and machinery, and while determining the value, you look at the asset physical condition and verify from the list given or the FAR given or whatever the thing and conclude the value. If the exercise is only to this extent, there could be a possibility of lacuna to a certain extent by the value. What sort of a lacuna? While determining the value under cost approach, or income approach, we accepting the market approach, we assume the balanced economic life of the asset. When we say balanced economic life of the asset, can the balanced economic life of the asset be determined by the valuer without having a statement to the extent of stores and spares suitable for the asset, fixed asset? So he need to comment on the spares and stores, which falls under the domain of a valuer who does inventory valuation. Invariably, they fall as inventory valuation. However, they are going to be used for the sustenance of the age of the machineries. Hence, he needs to have a cursor, at least a cursory look, may not be a deep examination, cursory look into the stores and spares. Then he has to fix the balanced economic life of the plant and machinery while finalizing the value of the assets. This is a key point valuer cannot forget. And whatever he does, he need to be captured in the report why he is addressing the inventory. If an inventory of a spares and stores are not there, then he has to think twice giving balanced economic life. What he thinks in isolation, machine can fail at a thing. And also here I use the cost approach and say IVS also in respect of special asset. These are the specialized machineries. Some are made to the order to suit the requirement of the specific manufacturer. Since I got a freedom to do under cost approach with the use of depreciated replacement cost or reproduction cost. There are the two options available for me when I say cost approach. Again, I have to say what method I am using, whether I am using a replacement cost or a reproduction cost. When I say replacement cost, I need to obtain quotes for the machineries, etc. When I have about 6,500 line items like this in a plant like this, is it practically possible for me to take the quotes for that? The question comes. Definitely not possible, practically not possible. Then I have to go for an option, no option but other than depreciated reproduction cost method. That gives I need to explain that justification to that effect. There are two methods, what method I have used, and the same spirit will apply to the buildings also. How you adopt is up to the wisdom of a respective registered valuer, and cost of post valuation determine the current market value. And here, in this case, inventory of fixed asset having total number of items close to 4,750 numbers relating to plant and machinery. So I already explained for this size and magnitude, it is not possible for me to do a quotations. Market comparables are not possible. I have to do reproduction cost. That is where I have to use indexing method. Reproduction cost. When I say that FAR is available to me, and whatever FAR, I am only concerned with the gross block and the thing. And when I say look at the gross block, when I review the fixed register, what are the signals it is emitting to me? This fixed register has been cross-examined with the financial statement of fixed asset 1516. Subsequent data is not available. That is fair enough. Whatever the data available, I've examined it. And the fixed register indicates machineries acquired in the plant right from 1975 till 2015. And also FAR indicates that the corporate debtor has taken a major expansion in 11 and 12 because a lot of items have been entered in the fixed register. It gives a signal that a lot of additional capacity examination. And if you cross-verify with the history of the company, that clearly confirms this. Machines were added at this period. And also when you look at the fixed register, various reasons, whether it is for the purpose of public issue or a change in management or for the purpose of collaborative arrangement, etc., whatever there, whether revaluation of the assets have been done or not, has to be first thing, need to be cross-checked before you admit cross value under the cross block under the fixed register, because that is the one which finally passed on to the calculations to determine the present market value. In order not to make a mistake in the calculation, cross-checking the fixed cross block is very, very relevant. And also, we are not tested. Data made available do not reflect either revaluation or any exercise of the impairment, the assets, etc. And here in this exercise, we are not addressing anything related to impairment. And if you are addressing, you should call it an impairment exercise. If you are not addressing, you should think of it. And probably indirectly, you have to address impairment calculations under resolution as well as under liquidation. Not directly, indirectly, to make the value to be fair. Why? The asset, the plant is for sale and resolution purpose. What is impairment? The asset which gives contribution to the exchequer of the company, which helps the company to generate income, is an asset which is not impaired. Or the asset which is not given contribution for more than 2 years in the past, or not likely to give contribution to the manufacturing activity for the subsequent to 1 to 2 years in the wisdom of the management, or impaired asset. When even in resolution, an intended buyer will be buying the asset, will you give a full value to the impaired asset? Because he doesn't need that asset. Why at all he need to invest on that asset? Whether you like it or not, those assets have to be identified by a valuer in one resolution by a separate group, and what value you give for an impaired asset value, that means more like a liquidation value to be for specific assets, has to be allocated to that group of assets with the proper explanation to that effect, so that the valuation exercise calculations become transparent in your calculations. And also, once a FAR is given, the crucial part for a valuer is to understand how the FAR is drawn, what are the components of the cost which has gone to the gross block of FAR, whether it includes hard cost, soft cost, or any other cost. If it all includes soft cost, more particularly preliminary preoperative expenditure, interest expenditure, foreign travel expenditure, all these things, etc. And hard costs such as GST charges or earlier sale tax charges, etc. Depending on the application at the current date, how this has to be used, that gross value in a fixed register had to be broken into pieces and only the asset value to be taken. While resolution process, it is a continued use of the asset in the same location under existing use. Certain aspects have to be recognized, certain costs have to be recognized, and in liquidation, certain additional costs need to be recognized to be eliminated. I'm talking about recognition for elimination. Otherwise, calculations could go wrong. And it is a very, very not complicated. It is very simple. What component, where it fits, how it comes. If you are able to understand those things, it becomes very, very relevant. Maybe sale tax is loaded to the thing in the earlier. Today, it is available for a credit in the name of GST. change in the economic condition of the thing, and those things should not be loaded today. Today, what facilities are available today are the determining factors to determine the revised gross block. Before you venture into calculation, gross block, whatever appearing in the balance sheet of each machine, should not be taken into at the face value, to be bifurcated and split, and revised gross block need to be determined. Revised gross block for the face value of the asset. When the face value of the revised face value of the asset has been determined, then your process of indexation starts. Now, indexation, can it be done arithmetically? Answer to that is no, because indexation will not address the economic or technological obsolescence, if at all anything from the asset is concerned. But as a valuer, you have no choice but to use the cost approach. You are using the indexation. For that purpose, again, the valuation standards come to the rescue of a thing. And ASA standards, American Society of Appraisal Standards, clearly stipulate that valuer, it will not bar a valuer to non-usage of the indexation, but it cautions the valuer to be extremely cautious when he is using indexation in the assets age of beyond 10 to 15 years. That gives an indication that blind application of indexation will only inflate the gross value of the asset than any real meaning to that effect. That is the reason one has to be cautious while using the indexation, even on the net gross asset value, derived gross asset value. And this is what you are doing: operating asset and non-operating asset, and bifurcation to the, and it is not complex or too difficult with the Excel sheet. Once you load it to the Excel sheet, by filtering it, you can segregate it. It will save time also, and you can make it in the blocks, and there is no point in calculating doing entire calculations for the entire 4,650 items. No, you have to group age-wise, group-wise, life-wise, balanced life-wise. You group the items through filter process and put the calculations, etc. It's much faster and easier, and one has to make the technology useful to that. And details of calculations cannot be addressed in a webinar like this. It can be through only classroom sessions where doubts can be cleared only one-to-one across through calculations through a blackboard or a computer calculations, etc. And here I mentioned in this specific case, though indexation period 2005 is available, indexing is not applied to those machines. In this specific case, mere application will only estimate reproduction cost or beyond recommended by ASA standards, and we are not used it here. And reproduction cost of brand new plant and machinery and allied assets, still the plant commissioning have been estimated using the latest available indexation, broadly application of class of machines published by Ministry of Economic Affairs. What indexation you used, and Government of India for a specific group of plant and machinery and allied assets, and accordingly this has been done. And here since it is for the liquidation purpose, I am not given weightage for the balance economic life, and that also to be very clear. And the company has classified certain assets as low value items. We also agree with that. By after due class verification, after due cross verification, and if you look at the items, etc., the provisions under the Income Tax Act, I don't know whether it could be revised or not. Earlier provision was capital assets up to 5,000 rupees can be written off in the same year by debiting the P&L account with 100% depreciation. And now I think, if I'm not mistaken, that could have been enhanced to 10,000 rupees. Some companies are using that benefit and some are not using. And again, depreciation, once valuer should remember, it is the policy of the company, provision under which the statute gives, Company Act gives, and the Income Tax Act gives is only for the usage benefit for the assessees or the users of the report and for their convenience. If the corporate management policy of, I say the depreciation policy, depreciation application policy of the company, some companies making higher profit, they prefer to, instead of paying a tax, they want to write off in the same year of acquisition to the extent permitted as per the rules and show a lesser profit, pay lesser tax. And some companies which are about generating higher profit, not to get show a loss or become an eyesore in the eyes of stakeholders, showing a poor profitability, they would like to retain the fixed asset so that asset jumping of the asset value would give a different meaning in the stock market. This is the thing, the corporates use these techniques to adopt a depreciation policy, and we should understand these things while doing the calculation, etc. That becomes ease of our doing the exercise. And here come to the estimation of asset value on a standalone basis. And the process of the plant, except for a few general purpose machines, many of the machines are special purpose machines and tailor-made specific to the need of the company. And they are not marketable in isolation. Hence, and too large a number, when the too large a number are there and difficult, and valuation in the standalone is not possible and is not practical too. That is what I have explained here. And there is a situation of a slump sale situation. I think barring exceptions, 90% of the situations, definition of slump sale clearly says it is nothing but a transfer of a whole asset, dictionary meaning, or the business concern as a going concern, lock, stock, and barrel by virtue of the meaning. It implies that a slump sale is more related to the lump sum discretionary value of the assets to be determined by the owner of the asset. In this case, it is the RP who is the owner of the asset. For transaction, do not give any scope for a registered value to estimate the value. Hence, no specific value is given into this. That means valuer has no discretion to implement the slump sale. Why I have no discretion as a valuer? I have clearly exhibited here. It is for the user of the report to draw an inference how he has to bear the slump sale. I will leave it to his wisdom without interfering in his freedom. Value of the assets as collectively, yes, this is possible as a line item. We have calculated and did as a collective basis, and values have been derived. By doing so, liquid value of the subject assets collectively as well as in parcels invariably remain to be same in the instant case, and reasons for that is been given. Many a times for two categories, the values will be same. Those reasoning for that has been explained here. While the parcel, may not be any synergy between each of the parcel of the assets in isolation, though equipments offered collectively, sale of which may not be from their economic utility point of view, as such the situation may not command any additional premium in value compared to the values in parcels. Why these IBC valuation regulations state that different scenarios? It is only on the spirit of maximization of the value. To give a discretion to the RP when he is liquidating the assets of the corporate data, how he has to liquidate, how he can give how he can recover maximum value to the stakeholders. Under that spirit, the rules and regulations have been drawn, and it becomes basic duty as a valuer to support the regulation. Under that context, they need to be keeping the spirit, calculations need to be done, and estimation of liquidation value of assets in parcels. And here, liquidation of assets are valued on a piecemeal basis. In other words, synergy of value between different classes of assets is not considered. Since the uses of different sections of assets are expected to be different, as the assets are sold in parts, synergy of value between such assets is not available. When it is not available, there is nothing can be done. However, the corporate debtor in the fixed register group land as a separate item and buildings in different blocks based on the date of capitalization. Plant and machinery as well as allied assets into 11 parcels as such, taking into consideration uniformity of the assets. We have also considered entity of assets, entire assets covered under the scope of under exercise 11 as 11 parcels. Accordingly, the value of the assets made from reproduction cost new obtained. Following treatment has been given as per the market perception in vogue and applied accordingly. Here comes the dissection part of the gross value. This, after understanding the capitalization policy of the company, discount due to capitalize the extent of duties, taxes, proportionate preliminary and preoperative expenses, transportation, loading and unloading charges, erection as well as commissioning charges, proportionate interest on borrowing, proportionate cost of trial production as applicable to specific asset, and such similar exercise as permitted as per prevailing rule under different acts at the time of capitalization at 36% as per industry average. In a summary, I mentioned as 36% of the gross block would determine. This 36% has got a breakups, and breakups are explained in my calculation sheet, which forms an Excel sheet and which becomes an annexure to my valuation report. If this has been done by RV, this can give a clear transparency in the exercise. And this 36% is for this specific application. This can become 24% in different scenario. The revised gross block, and the revised gross block becomes how much to discount it to make the value realistic to the current level is the things, because we are the exercise is not asset valuation, not a business valuation. If entire thing is taken into consideration blindly without application of these things, what I'm talking about now, the report can be mislead, or if the assets are from the angle of a business valuation, then I can give, instead of 36%, I may use only different one, like GST and other things. I may use it, others I may not use it. That is where the bifurcation or the dissection of the fixed gross block under fixed asset register. Gross block means the capital cost. Meaning of gross block is capital cost of the asset. So bifurcation of that, if that is being done, probably you will get abundant clarity to the calculations, etc. Similarly, when I say the gross block, land and building valuers also, here I am going to give a clue to them. More particularly the assets which are of less than 10 years old. In this case, the company has gone for an expansion in 11 and 12. It is not even 10 years. Yes, here, yes, they are doing evaluations as per using the valuation, the plinth area rates as specified by PWD, state PWD, whatever could be the thing, and value addition, deletions, etc., based on the specifications of the particular asset. However, when in case of a specialized building, there is a possibility that unknowingly error could have cropped up in their calculations, etc. It becomes these methods can be a big tool for them using this financial to cross-check that. Probably if a valuer in 2022 or 23 wants to cross-check the calculations of the reproduction cost new office land and building alone, we can cross-verify with the gross block of the capital asset, whatever drawn in 2012, and index it to the today's value. by using his own index, whatever the index he uses, RBI index or whole place per index, whatever is the thing, and cross-check with the valuation, cross value arrived, reproduction cost arrived by him today. And invariably, if you test it few things, it will be very, very close to each other with hardly any difference of 1 to 2%. That can give an enormous confidence on the registered valuer to proceed further in the matter as regard to the calculations are concerned, as regard to the accuracy of his calculation. There are the methods which you can use. And again, in this case, the plant and machinery valuer should give, whether it is a resolution process or a secure lending process or other thing, while applying the gross block, splitting of the gross block. When we saw the location of the plant, some of the machineries like power plants and various service facilities like STP, so many things are ETP, effluent treatment plant, power plant, which is the service provider. All these things are installed in the land not owned by the company. In the event of resolution, they may not be available for the continuing person. And if he blindly does the calculation, probably that gives the inflated value and resolution may not happen. Probably he may have to do the appropriate calculation to hypothetical shifting of those plants to the vacant land and apply that appropriate discount for that so that the resolution can happen. His effort should be for the resolution to happen so that the country can recover value maximization benefits. Mere applying arithmetic will not give a result for that. Of course, in the case of a liquidation, the issues are not there. And in the resolution, even under secured lending also, if those machineries are installed in the land which is not owned by the company, if that land, it becomes the duty of a valuer to check with the lender whether that land is also mortgaged to the bank or not. If that land is not mortgaged to the bank by oversight or intentionally, whatever could be the reason, then either he has to take a consent of the banker to do the valuation by treating it as a rented premises, or if no concrete conclusion is coming from the banker side because they are averse to give any judgment by their attitude and the perspective, to avoid any probable issues for himself in a later date, he should give it as a departure. Those assets are not owned by it's a departure, even if you can give a disclosure to that effect as a caution. And when I say the caution, remember, if you look at the valuation standards, RICS standards for the, I think it is published in 2014 or 16, Indian context, when a valuations is done for the secure lending, there is a possibility of a risk factor in any valuation. The risk factors need to be explained in the valuation report. It is the basic duty of the valuer. And if the land machineries are not located in the land which is not mortgaged to the lender, disclosing that becomes, or cautioning the banker about the associated risk factors becomes an abundant duty when you confirm the valuation reports or in compliance with the valuation standards. That is the reason of explaining these things here. And in the second scenario, I've taken 33%. The reasons are explained in the report. I hardly have about less than 15 minutes since I'm rushing through the thing. Different scenario. And other scenario, I've taken 18%. And I consider lifting, loading, and these are the liquidation process. I consider the 0.5%.
Is there any basis for this 18% which you have taken?
Just 1 second.
Foundation.
18%.
Yeah, this one. Dismantling of.
Yeah, these are the liquidation. How the liquidation process happens.
No, this
To
18%.
be now to derive the liquidation value from the gross value.
Okay.
There the treatments I have given. In order to make the report transparent, I've used all these things, etc. I was explaining when you go into the deeper Excel calculation through a workshop, probably each participant will be able to explain in a shorter time. I'm only giving the concept behind the whole process.
Okay. Okay.
It is not my thrust at this session is only to say it is not percentage basis, lump sum percentage.
Right. Right. Thank you.
What everybody is following, 80% or 90%, 85%. No, it is not so. This can be determined scientifically. This is what my submission.
Right.
See, there is a loading and what all the factors, as if I'm a part of the transaction. That is how it has been estimated. And less than 1,000 company has considered. That is also I have considered. And also now here, company is free to make dice and tools as a part of fixed asset. Should I have to value the dice and tools at the full value? This is a real question. Dice and tools, when is a real value, I examine the dice and tools. When your logo is there, mark is there, brand is there, etc., all those things, then I need to be extraordinarily cautious while assigning the value to the dice and tools. If it is a resolution process, yes, I give a full value to the dice and tools. At the way I determine for the machinery based on the balanced life, I give a full value to the dice and tools. Whereas for the same dice and tools, when I am assigning the value under liquidation value, I do not give more than the salvage value for that. Because it is a restricted market. Similarly, some of the machineries like X-ray equipment, which could be in the production line to check the quality of the machines, or it could be in hospital X-ray equipment, which falls under a regulatory mechanism to install and sell and buying and all those things. I'll be extra cautious while fixing the value for that. And saleability, as regard to the saleability, those equipments cannot be sold to a Tam, Dick, and Harry. It is my duty to caution the user of the report about saleability of these reports, because the buyer also should hold a special license for those things before he participates in the action. That is what is the thing. And spirit of above and the value conclusion has been made. And this one, and as a going concern, what are the values I made? This is how, again, the here percentages are different treatment. And the calculation part, here I say 36%, 26% in the next one, and 22% in the third one. If I say that, each percentage I want to break up in my Excel calculations. It is not arbitrary. And the value conclusions have been done and parcels have been done. And thereafter, assumptions, limitations, etc. I'm rushing through, hardly 10 minutes is there. And there could be a possibility of leasehold assets also. How you treat the treatment for the leasehold assets. If you are treating a leasehold asset, you should check the leasehold status of the assets, whether it is a land building or a plant and machinery. Leasehold status has to be appropriately addressed with a cross-checking, whether it is a operating lease or a finance lease. You should cross-check from the financial statement of the company, whether it is a different treatment, if it is an operating lease, if it is a different treatment, if it is a finance lease. Accordingly, the classification and the value determination need to be done. And here, what are the assumptions, limitations, disclosures, and departures mentioned here are outside the thing what I felt was necessary other than the one which is given by IBBA as a guideline to the valuer. IBBA has given 16 pages guidelines to the valuer, use of disclosure, departure, limitations, assumptions, etc. relevant to all the three class of assets. I earnestly appeal all practicing people to go through that thing in detail and understand that and its interpretation and use them freely in every report so as to avoid probable damages to the damages of consequences of the preparation of report. And material value uncertainty I have explained, and departure. What is the departure? In this case, here, some of the machines are imported machines. I know invoices nothing. So in one case, while applying index, I said I will not use more than 10-15 years of index. One shelter I have taken. But however, original price is not available. International market, I am supposed to use international index, country of the origin, index more closer to the country of the origin. I'm not possible for me. I use domestic index. Have you used the device, even the cost approach? It is a departure from the basic principle of valuation. I explicitly mentioned I use the domestic index as against Marshall index due to non-availability of import cost at external currency. It is not available to me. I need to complete the job. It is a constraint I have faced. And if it is a total departure, it comes under departure. If it is a minor nature, it is not a departure. It comes under a limitation. Here is a serious thing. Serious things do only appear in the departure. Otherwise, it comes under limitations. And there are loose items, etc. Inventory I have not done, or all the things, etc. Those things I explained as a thing, and disclosure of material involvement, etc. And extent of investigation, what I covered, and consent for all these things as per the standard, which you are already doing it, and attach annexure as the thing, all these things. And if an inventory is there, cover in detail about the inventory valuation, how inventory valuation has been done, explicitly explain to that effect, so that if it is a part and parcel of the report, then the report is complete. Now, hardly 5 minutes is there. I will open for questions, if any clarification on the present presentation. Because, sorry, because the paucity of time, I have to rush through. You are free to ask questions, sir. I'm open for questions.
Sir, I'm land and building valuer,
Yeah, please.
especially for the calculating the instead of arbitrary discount, no, under liquidation case. So you said you have done Excel sheet and then you have taken the things to represent
Correct,
18% or
Correct.
so. Just
correct,
briefly, can you give for the land and building? So how we can arrive at some percentage, which is what is the scientific?
That means, suppose more particularly, if I take a situation of a liquidation process,
Okay.
how good the structure is there for utility? What is the habu of the structure? As a land and building valuer, you are expert in doing the habu of the land. Why don't you do the habu of the building itself, structure? Comment on it, build it a record to that effect. How best that can be used? Will it give the maximum value maximization? When the alternate can be put for an alternate correction, what is the best value it can be done? With that, you can derive it. You have to find out your innovative ideas how to do that.
So one example I could
Suppose,
see there.
one second. I'll tell you.
Yeah.
You are doing arithmetic calculation of the cost of construction, putting it, cost
Right.
approach. Okay.
Yes.
And the current structure is of no use to the buyer.
Okay.
No use to the buyer. Just to give an example, in the secure lending valuation, we have seen from experience, not a comment, temporary structure of a watchman being valued at some X price. Continuing. Every time temporary structures are being valued. Will it really gives a value to the banker? Whether a buyer will pay to the value to the temporary structures? Even dilapidated structures also, they said building is dilapidated. The statement is there in the report. And depreciation, value has been given. On the contrary, the structure, the recovery is going to be poor. That gives a marginal negative value to the asset. Taking the original land. You can do all these things, etc. How good the structure can be used. Taking the best use. You know the geography of the land, locality, good locality, already 30-year-old building, 1975 plant started. This plant itself, I'll take it for example. What is the year? It is already 45 years. What the benefit the existing structure can give? How long? What is the FER used? How the design of the building is there? What is the ground coverage? You try your wisdom. Hypothetical rental method, you give it as a warehouse, as a renting. What maximization benefit of rentals that property can get in next 20 years or 30 years? Or in the same status, how much rent it can fetch? When you do the how exercise, probably you get an answer for this. And say that half of that value and say that is a salvage value, for sale value of the land and building.
Yes, I got the point, sir. Thank you so much.
Yes, sir.
Yes.
Any question?
Yes.
See what we should get immersed in the assignment. When any valuer gets immersed in the assignment, he gets a solution. And immersing is there are two immersions are required. One immersion in the valuation standards, and second immersion is the case. Make a marriage between these two. You find answer for everything.
Thank you. Thank you. Thank you.
Any other questions, sir?
Hello. Hello.
Yeah, tell me, sir.
May I, sir? Hello.
Please, I'm hearing. I'm able to hear.
Yes,
Sir,
yes.
my name is Sanjeev Kumar Gupta, Plant and Machine. One assignment I have received 2020, and
Yeah.
he director of that company is asking me
No,
for
your voice is
investment
breaking, sir.
value.
Your voice
What
is breaking.
valuation approach?
Your voice is breaking, sir. I am not able to hear full question.
Sir, one plant.
No, voice is breaking. Either you close
Hello,
it or
sir. Are you
mic
hearing me?
proper.
Are you hearing me, sir?
Yeah, tell me. Slow. Tell me slow. So that it will not break. Voice will not break.
Sir, one plant is shut down in 2020.
Yeah.
And the director of that company is asking me for valuation, investment value. What is the approach should I use?
What
Valuation approach.
Investment value, correct.
Well,
What for it is?
investment value
Sir, investment
for
value.
a new adding
Please.
adding
And I got your
a
question.
new partner.
No. I got your question.
What should I use?
See, any statement comes from the user, it's invariably always a vague statement because they do not know how to tell the value. They think every valuation is the same. It is not their mistake. It is our duty, if possible, we'll educate them how the valuation report, or if they are adamant, if they are not willing to listen, forget it. It is not the question. It becomes our basic duty to understand how the report is going to be used, what purpose, where our report is going to be used. Once you get to know this key, you get all the direction. Your route will be clear. Unless you understand this, you will not find a solution to the solution or the direction to proceed in the matter. Is it for a partition?
Yes, sir.
Is it for between the
Sir,
partners or for sale? What it is, or just a confirmation of investment? Remember, confirmation of
For
investment
adding
is
a
not,
third,
is not a market value. It is the confirmation of amount spent in the project. Cost is different. That is purely a cost, not the market. Am I
sir,
clear?
he is saying that I have to, sir, he is saying that I have to add another partner for this.
He wants to have another partner.
He just want to add another partner.
Yes,
So
sir.
according to me, what you can do, you can see the capitalization cost, you can inflate by RBI or whatever index and then put in some kind of a
No,
deposit.
no. He is not supposed to dictate about whether RBI index or something. No. It is the marketability of the asset need to be determined.
No, he is just
No,
telling.
let me complete,
to
sir.
add
I
some-
understood.
He is going to
I
add.
understood your question. He wants to induct a new partner. You
Right.
have to do the valuation of the existing asset at 100 rupees,
Yes, sir.
whatever the thing, as if the unit is for sale. Through market value. Then he has to recalibrate his share value, whether the share or a percentage, etc. And we want to take 10% for the calibration arithmetic. Any chartered account will do the arithmetic calibration, 10% dilution, 2% dilution. As if the marketability of the product, if he wants to sell this product in the open market as a going concern, how much he is going to fetch. That is the value of the asset.
Yeah.
Clear, sir?
But there is no market.
Voice is breaking, sir. Your network connection appears to be good. Unable to hear. Any other question?
Yes, sir. Good afternoon. It was very
Yeah.
much interactive. I just wanted to know that many a times parallel economy is prevailing in the vicinity for land
Yeah.
and building purposes. So,
Okay.
do we have to take the discounting in fair value or in liquidation value for IVC purposes?
Sir, for your information, every value market recognizes the parallel economy. Whether anybody gives it in writing on the parallel economy,
Yes, sir. I generally write in my
people
report that
talk. No, listen to me. People talk about parallel economy. Anybody gives it in writing, duly signed on the parallel economy.
no, sir.
None. You are giving valuation report with a bank valuation, retail, or whatever is the thing. You are giving it duly signed. Now you have to decide whether you have to sign for such parallel economy money or not. Whether bank can receive parallel economy money. For bank, you are doing a valuation.
No, sir, I'm talking about IBC purpose.
Please. Sir, all purposes.
For CIRP or for liquidation.
Any purpose. Remember, corporate transactions will never have a parallel economy money. Or industrial transactions will never have a parallel economy money.
Absolutely.
Even
correct.
in the case of a retail, whatever you are doing it, even if your brother buys a property, you are a part of negotiation. You finalize for 90 lakhs of the property, flat and apartment, what you are for your brother. And you have been asked to give a valuation. Maybe he is your cousin brother and you are not falling within the family. You are not part of giving a valuation report. Remember, still you cannot give 90 lakhs certified though you are a part of the negotiation. because he's resisting it only for 60 lakhs. 60 lakhs is the value of the property to which you can certify to the banker. 90 lakhs, 30 lakhs is a parallel economy. You cannot give it. However, at a special case, if at all you want to recognize the parallel economy money, 30 lakhs is a differential money. It is a non-tax paid money. Convert it to tax paid money. Knock off 33%. It comes to 20 lakhs. 60 plus 20, 80 lakhs at the most you can certify, because in the event of sale by the bank, there could be some buyers who have got 100% white money. They can buy at 80 lakhs. Nobody will be willing to pay 90 lakhs white. That means if at all anybody is paying 90 lakhs white on 30 lakhs differential on the previous purchases money on the date of valuation, he is known fact that he will be paying 35% more to the property. Am I clear?
Absolutely, sir. Thank you.
Any other question? If you are convinced,
Sorry, one.
Yes.
Uh,
yeah, please. If any questions, I have no
written
restriction on
here.
time.
Appendix.
It's my
Hello.
privilege to answer you. I don't want to keep anything suspense. If I know, I'll answer. Otherwise, I'll get prepared and answer you after later.
Sir, what is the difference between sale of the assets as collectively and a going concern?
No, different. What is the sale of? Please repeat.
Sale
Please
of
repeat.
assets as collectively and sale of assets as a going concern. I want to see that
Yeah.
sheet, sir.
I think for this you need to first you need IBBA regulation circular. I mentioned the circular. No.
What are
Exchange.
the,
I'll give
what are
number
the
of-
major factors? What are the major factors involved?
IBBA notification 6/1/2020. You need to read this. Is available in the IBBA website. There's a old notification. If there is a revision, you can get updated. I have not checked up post this date.
This is what are the major difference value?
Pardon me?
What are the difference values between standalone basis and going concern? What
That is what I said.
is there any specific?
No, once you read this notification, you will get the answer there. It is a lengthy answer. 5 minutes, I cannot answer your question. It takes at least half an hour to, with calculations, I need to explain. That is what I explained with the percentages, etc., all those things. The treatment to the asset, what treatment you give. See, each is a scenario. Each is a basis of value, sub-basis of value. I was explaining about the basis of value. Liquidation is the basis of value. Under liquidation, these are the 6 scenarios, are the 6 different basis of value, sub-basis of value, as per IVS. Accordingly, the calculations need to be done. Basis of the value is the one which drives the value of an asset.
Okay. Sir, please share this sheet to us.
Sir,
Please share this whole sheet, sir, to us also.
apologies to you, sir. PowerPoint is not for sharing, because my experience is I have shared with many in the past, and people have not done the homework. They have not read it. I want people to read, get enriched, so that you are the signing authority. By copying this, I don't want anybody to get into problem by not be able to explain when the inquiry is being made. Only with your humble effort, you can save yourself. You can only show the directions, how to save yourself from the regulator. If you got any difficulty, you can always approach me. My number is available in IBBA. Sorry, my email ID is available in IBBA website. You can approach me anytime.
No.
Absolutely no problem. To the extent
Okay, sir.
possible, no issue. This disclaimer bars me in sharing the thing. Misutilization. Why I don't share, honestly, don't mistake me. I have faced inquiries on account of that. Just to give you discounted cash flow calculations, I gave it to one valuer like this in the presentation. He copied and gave a valuation to the bank. Same everything without understanding it. When the result came wrong, he said, "Sir, this is Chandrasekhar's calculation. I've used it." Bank called and banged me. What do I answer to the bank? He has applied wrong discount rate, wrong capitalization rate, because it varies from case to case, situation to situation. I had to face an internal inquiry with the bank unofficially to save my image. Okay, sir, shall we take leave? No
Thank you.
questions are there?
Okay, sir. Thank you.
Thank you.
Thank you,
Thank
sir.
you.
Thank you very much. Thank you.
Thank you.
Etc. Yeah.
Hello, sir. Yeah.
Yeah.
So shall we end the session now? It's 1:15.
Yeah.
Okay. Thank you, Chandrasekhar sir, for
No
such a
question.
nice and informative session. And I hope everyone like it. And thank you all the RVs for being an active participants. And we have other CPs lined up for Saturday and Sunday, that is 25th and 26th of March. So the one who are interested for more CP, please visit our website and register over there. So thank you all and have a nice day.
Thank you.
Thank you, sir.
Thank you, sir.
Thank you.
Thank you, sir. Thank you.